Good afternoon, everyone. We're excited to be here. My name is Jed Rose, a partner with Antler in the UK.
And I'm Arabella, VC Relationship Manager at Google Cloud. Apologies for my voice. It's a bit croaky.
So we've got an exciting afternoon plan, but first, a few words from Google.
We'll just go with it. So firstly, welcome. Thank you so much for joining us today here. Delighted to co-host you here with Antler. As I said, my name is Arabella Reeves. I work as a relationship manager for VCs for Google Cloud across UK and Ireland. It'd be remiss for me not to, thank you, mention our startup program whilst we are at our offices. We want to support startups from the ground up. We want to provide them resources across 4 different pillars. The first being financial credits, obviously, which I'll get to in a second. But also, once you're using GCP, we want to optimize your spend. Business across our product areas, across Google and Alphabet. So it's Maps, YouTube, Android, etc. The third pillar is technical. This is architectural reviews with our customer engineers, and one-to-one mentoring sessions with the engineers. And finally, community. So community is speaking at Google's events, but also we want to help promote businesses. So joint case studies, blog posts in our newsletters, etc. The finance. So Google Cloud credits. As I said, we want to support you. The credit program is eligible for startups up to Series A. You get $100,000 for year 1. And because we want to support you throughout your journey, you get 20% off your second year up to $100,000 as well. So $200,000. And if you're AI first, it's $350,000 that you'll be eligible for. Please scan to get started, but also connect with me on LinkedIn if you want an introduction. Thank you very much. I'll leave you and hand back over to Jed.
Thank you. One more time, a hand for Google, guys. Thanks for hosting us. So I think most of the room know about Antler, but obviously some key numbers and some key things to highlight. So we're a global venture capital firm on 6 continents, 27 locations around the world, growing super fast. As a global VC, we are unique in that we are a pre-seed investor. So we invest at what we call day 0. In many cases, it's teams before they even form, before they even establish their businesses. We're there all the way through Series C. We have the ability to do follow-on funding. We're industry agnostic with over 35 different sectors. And then we have a fantastic global team that's there to support for introductions to investors, talent, advisors. You can see some of the big numbers here. I mean, these numbers literally get outdated every day because you're in 27 locations, over 1,500 portfolio companies, 10,000 plus Antler founders. They've gone on to raise over $1 billion in external capital from other VCs and investors. And as I mentioned, scaled up across the entire world. You're going to see this slide a few times. It'll make more sense once the companies come up to pitch, but this is the QR code if you want to learn more and meet the teams from our portfolio. And with that, we'll move on to the next section. So really excited to introduce Andrea, who's one of our global partners. Antler's now over 300 people around the world. She's one of the first 10 people. So has a lot of history here, been with us for over 6 years. Please join me in giving a warm welcome to Andrea, who's going to give you an optimistic view on 2025.
Thanks a lot. Hello, everybody. Good afternoon. My name is Andrea Hoiduhau, and as Jed mentioned, I'm a single-digit employee, which actually doesn't really mean anything. It just means that my surname is not in my Antler email domain. So you can find me very, very easily because my surname is extraordinarily complicated. There is only me and Jed one more time and a little bit of a coffee break that stands between the main reason for why we gathered here this afternoon, which is to introduce you 20 of our most promising startups from the United Kingdom, and we are extremely excited that they've got a chance this afternoon to talk to you. I will be very quick. I wanted to bring a very optimistic view to you today. But before I do that, I wanted to explain what I actually do at Antler so that you can put it in context. My day job is that I look after capital origination for us. So for all of our fantastic startups to be able to get funding from us, we obviously have to raise that money from third parties. So I joined back in 2018 when our AUM was less than $6 million. We are thankfully further away from that from now. And what that means is that we are able to provide startups with the starting capital from pre-seed, and as Jed mentioned, all the way to seed. Now, there has never, ever been a better time to build. Okay, I'm going to ask you guys a question, and I would love you to actually shout out some of your answers. How long do you think it took Netflix to get 1 million paying customers? Roughly, how long? Sorry? 15 years, 5 years, very good. A bit lower than 5, though not that much lower, so it's 3.5 years. Now, how long did it take OpenAI to get to this number? 1 million customers, not paying, but 1 million customers. 5 days. Okay, so why are we so excited? Why are we excited about all of the things that we are going to be able to, all of the founders that we are going to be able to support? And how do we do this? So Jed has given you the big picture. I won't spend much time on it. I think the real thing that I wanted to say here is that we've taken the view back in 2017 when Antler was first founded, is that talent is equally distributed. Opportunity, sadly, is not. So from a founder's perspective, when you think about Antler, our mission is to make sure that all those founders who are building the most exciting portfolio companies of the future, solving the biggest problems, they are able to get networking support, they're able to find their co-founders, and they are able to get some capital from Antler. And we do this over and over and again. Now, founders are a very, very important stakeholder group. They are one. Number two is our investors, of course. And those are the investors that I mentioned to you that I work with day in, day out, our limited partners who entrust their capital to us. So from their perspective, what we are doing is we're institutionalizing the very early stage of the venture capital asset allocation. How do we fit into the ecosystem? I think most of you here are already familiar with this. Actually, what happens is that venture really starts here. That's early stage venture. Before Antler came into the picture globally, of course, others already exist who are doing this locally and have been pioneers for this. But no one's ever, before we came into the picture back in 2017, 2018, have actually done this at a scale that we are currently or have embarked on doing this. And what that means from an investor's perspective is that there is now a way to actually invest into early stage innovation. What I wanted to show here is that actually we are venture capitalists just like a lot of you in this room. We just happen to start earlier. So what you call deal origination, we call founder sourcing. This year alone, we will have 160,000 founders who apply to us, and we will have said no to 98%. So when you say you're doing due diligence, we actually welcome them in our residency programs across the globe, twice a year in every location that you saw on the map, and we spend somewhere between 8 to 10 weeks with them before we actually make a pre-seed investment. So why are we super excited about 2025? Let's look at this for a second. So I've mentioned to you earlier that we believe that we are perhaps the only ones who globally try to institutionalize this very early stage. Now, why does this matter? It matters because if you look at this, over 14 trillion of market cap currently, the top five public companies currently in the world have been venture-backed. And there's not been a way to actually access these companies at the super early stage. All right, a few things that I'm going to go through quite quickly, but actually these are really interesting stats and gives us a lot of optimism for 2025. So first of all, if you look at the first chart, and it's probably very small, but the key takeaway there is that actually things are normalizing. So we're back to levels both in terms of funding on a Q-on-Q basis, as well as deal volumes, pre-pandemic levels. This is actually very encouraging because what this means is that the market is normalizing. What you can also see is that the deal sizes are actually also normalizing. For us, what matters is that you can see at the very earliest stages, so pre-seed and seed, really the valuations haven't moved that much. In fact, if anything, actually, they show a tiny little bit of an upward trajectory. So actually investing as an investor into the earliest stage of the venture market makes a lot of sense, given that you systematically invest at the earliest stage, at the lowest valuation, which from an investor's perspective, of course, has the promise of a very good outcome. All right, so We believe that 2025 will see or continue to see the digitalization of everything driven by market demand. You can see things here that will make sense, a lot of sense, right? We've got per household data usage. You've got the resulting data center actual wattage that will be used by what will be needed for these data centers. And then the other thing that's really interesting is what's changing is that the vast majority of the population has already flipped into 4G, and we will continue to see more and more people using 5G continuously, which basically means that they will be continuously needing more and more data coverage. A couple of things here, which I think is probably the key message of this afternoon from my perspective, is that actually it's never been easier to start. There are two main reasons for that. One is the power of cloud computing. You know, we're standing in the building of one of the giants of this particular business. The price of cloud computing has brought down absolutely the price of this has brought down the ability for startups to actually set themselves up in a much more cost efficient way. If you look at it 20 odd years ago, probably cost you about $5 million to get to the same stage. What will cost you today about $5,000, given all of the advances that cloud computing has brought to us. So you no longer need to, when you want to set up an e-commerce platform, you no longer need to become a fintech expert for the payments or a logistics expert for the delivery. Or in fact, the actual product itself, you can just get it off the shelf. So it's a very different landscape than it was even a few years ago. Now, what will it change? It will change industries across the board. And this afternoon, you will see these industries represented by the 20 companies that we've invested in. So it will impact the way that we interact with technology through our IoT devices, AI, the hot topic, I would say, of 2024 and beyond, genomics, quantum computing, blockchain. We really are only at the very beginning of actually figuring out what these technologies can do for us. Now, finally, this is my final slide. I wanted to zoom into the UK, and I wanted to really focus on why we are optimistic about what's happening here on the ground in London and indeed beyond. So if you look at these, a couple of things that are really interesting. We are here the third largest ecosystem behind the US and China, and I think this will continue. For me, one of the most important things that I see on this slide, given how obsessed we are with talent, is that Cambridge is ranked the #1 university for tech talent. You will hear Jed in a moment talk about our European Founder Report. The simple most important takeaway is that you have to have tech talent because there is a direct correlation of really exciting, successful portfolio companies that were set up by tech talent. At least there was one co-founder who was actually had a technology background. So this is very, very interesting about the UK. Other than this, you can see that there is a really strong ecosystem here for early stage. I think we can do a lot more when it comes to scaling, and I think we see that a lot of the exciting UK companies are going to the US to actually scale, and I think this is something that, you know, we'd love to fix here in the UK, and I think a lot of you here in the room is actually working on this tirelessly. So, without further ado, I want to hand back to Jed. Thank you very much for your attention. You can find me on LinkedIn if there's any questions, and thank you very much for spending your afternoon with us.
Thank you. Thanks, Andrea. So as Andrea alluded, we're going to walk through the European Tech Founders Report. You got kind of a global picture. Obviously, a lot of optimism, really excited about where things are going, how tech is changing, but also very excited at the UK level. So we'll jump right in. So Antler, obviously we said earlier, global picture, 27 locations. What's really neat is this gets us access to data, right? So even at the UK level, we talk with other locations. We're going to be in Singapore in January where all the partners get together, and we talk about best practices, insights, what we're seeing on the ground. Now, a bit more detail on the residency. You know, effectively what happens is we're doing about 200 hours of due diligence per team as they go through the residency. This means we're literally at the pulse of entrepreneurship. We're seeing what the new founders are saying are the biggest problems to solve. Again, over 35 different sectors and industries. And so each residency that we run twice a year, we get 5,000 applications per residency. The top 2% are on-site at Antler here in London. And we're learning from them, you know, as far as what problems they're seeing and what needs to be fixed. The founders come from many different backgrounds. So we talk about the residency in 5,000 applications. Another way to think about it is we have 3 different buckets. And so the founders come from tech backgrounds. These are future CTOs. We got business leaders and operators, people who've run companies before. A majority have founded companies. A third have raised VC funding before. And then domain experts. These are people with PhDs, deep sector expertise in particular areas. Now on the top right, you can see where some of the companies that they come from, and universities as well. Andrea mentioned about Cambridge being the #1 university. That's for founders who raise 10 million or more. And so we see a lot of traction with people who have deep industry expertise and then wanting to build a company. On average, 10 years of work experience. Like I said, majority have founded companies before. And then roughly it's about a 45% tech domain split, and then 55% with business and operational background. So I'm going to walk you through 3 different things. And I hope kind of the key takeaway out of this is you get a bit more insight in terms of how we view UK dynamism. And I think the first thing is let's define it. We'll then walk through how we're unlocking scale for European startups from an Antler perspective. And then lastly, some insights on trends for the future for what we're seeing with tech founders. And again, this comes from looking at over 10,000 applications per year, investing in 30 companies per year at the UK level. So you've seen this picture all around the room. You've seen it in the emails as well. UK dynamism, investing in growth and innovation. A lot of buzzwords in one slide, let's be honest. You got the cityscape. You can imagine superheroes flying around, technology everywhere. But what does this exactly mean? Well, what it means is, if you look at the trends, the first thing is there's economic and tech stagnation in the West. And so there's kind of this negative contrarian view in terms of where the world is going. Ross Douthat, who's a New York Times columnist, has been famous to put these things forward, saying there's institutional failure, loss of civic trust with the government. You've probably seen polls that say a majority of people think that the world's going in the wrong direction. They're worried about what life will be like for the next generation. Declining birth rates, major trend globally. Institutional failure, and then derivative culture. Not just talking about the countless Star Wars movies and reboots that you see in sequels of movies, but just that is there originality that's happening culturally. And so some of the things that have happened recently, COVID, government, fertility rates, and then of course big reboots, these are all things kind of culturally that are potentially stagnating the economy and how we think about progress. Now, there's a positive side to this, and this is argued by Catherine Boyle, who's a partner at Anderson Horowitz, about the private sector versus public sector. And the argument here is that technology is actually driving the innovation, and that startups are becoming less of a sector and actually coming intermingled, basically, with societal change. And there's an argument that we're augmenting and improving functions of institutions that we used to trust. And so some good examples of that would be Uber. What has it done for public transportation, right? Suddenly private sector is now involved solving a problem. Palantir for intelligence at the government level. And then Mark 43 for managing public services. Now this kind of leads up to the bigger thing on national dynamism. And this is a term that came first with American dynamism, which is that effectively, the argument is that the private sector is better at taking on these risks. Startup talent is looking to solve large problems. And when they used to go to the government or the public sector, they're actually joining startups now. And that citizens feel country values are real and worth defending, but they're finding ways to do this at the private level within startups. Good examples of that, SpaceX, right? Cutting costs over 90% for rocket launches and delivering supplies to space. Samsara for fleet management, and Anduril for defense spending. Now, that's kind of the picture of national dynamism. And so when we say UK dynamism, investing in growth and innovation, that's effectively what we're talking about. So what is Antler's role exactly in UK dynamism? And the way to think about it, linking to what Andrea mentioned earlier, with the part that we play in the ecosystem, with finding talent, with talent sourcing, supporting them from the earliest days, such that they go on to make an impact, is we're playing a key part through supporting the next generation of founders who are actively solving the private and public sector's most critical problems. Now, let me go a level deeper in exactly what that means. We're talking about creating over 25,000 jobs through Antler's global portfolio by the year 2030, contributing over £3 billion to the global GDP. And then in the UK, it's investing in building over 150 companies, and then educating over 1,000 aspiring UK entrepreneurs in the UK within the next 5 years. Now, some other things to flag. Over 60 nationalities are represented across the founders we support. A third of our portfolio companies has a female co-founder, which we're particularly proud of. And then around 35% of our companies are defined as impact as based by the UN. So when we talk about impact and creating UK dynamism, those are the numbers. That's how we think about adding up. Now, of course, it takes a long-term investor to kind of play this out. When you're investing at day zero, it could take 3, 4, 5 years to get to Series A, and of course, growing there from beyond. And as Andrea mentioned, you're seeing more and more companies raise venture backing and stay private longer. I hope that made sense, but that's kind of defining UK dynamism. Again, it's a word you see thrown around a lot, but I think it helps to just kind of explore it a bit. So let's now translate this to unlocking what this means for European startups. Question to start with is a rhetorical one. Why is Europe struggling to produce tech giants at scale like we see in the US? And the way to think about this is, again, we're all across Europe continentally right now. And so what we've done is we've done one of the broadest studies of European tech founders to date, looking at the data. But then also, we have experience from investing over 300 different startups across 10 different European geographies. Again, there's no other investor that gets the scale and the access to data that we get for early stage investing. So there's some typical themes you'll hear quite a bit. Not enough growth funding. Obviously, there is a gap between Series A and Series C in Europe. That's bridging. There are investors that are here. Sequoia is here in the last couple of years. Andreessen Horowitz is here as well. That will continue to improve. Not enough public money. That's another one. Of course, the UK has one of the envious programs in the world with the SEIS and EIS investment scheme, which encourages private sector investment. And of course, a huge portion of funds that are raised is public. But there is an argument of, is there enough? Bureaucracy is overwhelming, having to file things, and regulatory. Too many different languages. So these are the things that you hear quite a bit. Now, these all might be factors, but there's also other possible things and other possible answers. And so I'll walk you through kind of the numbers that we looked at and explored and how we built up to this. So first off, from a data perspective, we looked at about 170 founders of the most valuable tech companies and unicorns across the US and Europe. We then looked at over 800 new unicorns, founders of European unicorn startups. We then looked at aspiring founders. Remember I mentioned we're at over 10 locations across Europe to see the applications, who've applied to Antler, what are their backgrounds. And then, of course, our portfolio of European companies we've backed since 2020. It's over 900 founders. It's probably around 1,000 today. So this is the data we looked at to try to build conviction as what is changing and what are we seeing. And what is the data telling us? Well, it's telling us that tech giants are almost exclusively built by tech co-founders, and the US is far ahead in backing tech founders. So the profile of founders you're seeing in these companies, much more biased towards a tech background. There's also too few emerging European category leaders that have been built by technical founders, and then in particular, over the last 2 decades. And of course, that trend is changing. And then lastly, the tide is changing as Europe backs more and more tech founders, and it pays off in higher valuations and larger funding rounds, which obviously is a virtuous cycle. And we'll walk through some of that, what that looks like in the numbers. So in short, Europe has never had enough technical founders that are solving these really hard to crack technological problems. And as Andrea mentioned, the top 5 or 6 companies in the world right now were all VC backed. So what the numbers say is that the technical founders have built the tech giants. And so you can see the difference between the US and Europe, right? It's roughly around 1/3 higher in terms of the percentage of companies that have tech co-founders. The 10 most valuable tech companies were founded with people with a tech background. And then, of course, when you look at the valuation difference, 14x. Now, there's a lot driving this, right? Don't want to make it sound too simple, but there is a big causal factor here with technical talent with these companies. And then you can see how long it took them to get there as well, with the majority of companies doing that in under 30 years versus over 40 years. And then on valuation different, similar thing, but the more recent generation of talent looks very different, right? So with Europe, we're seeing a 3x different, which is quite a bit different than before. And this is for founder backgrounds of the top 20 tech unicorns by valuation. And of course, only 14% have fallen unicorns. So again, it's a higher chance of success longer term. And then the imbalance is changing as Europe backs more founders with technical talent. You can see it pre-2023, 26%. Now it's more than doubled. And so you're seeing unicorn founders with more of a tech background. And again, this is a trend that we're seeing at the application level within Antler because we're looking at companies at the pre-seed level. So the increase in European tech founders is continuing to grow based on our deal flow. So when we look at companies, we get over 1,000 applications and submissions per year for companies looking for funding. We're seeing 4x more technical founders and then 8x more founders with AI and data backgrounds. Like Andrea mentioned with why is London and the UK exciting? Well, of course, it's one of the great hubs for AI. Google, DeepMind, Apple, Amazon, Microsoft. A lot of their AI departments are based here in London, Cambridge, and Oxford. And then, of course, we're seeing the founder growth in engineering growing significantly in their data backgrounds. So when we get these applications from founders who are joining the residency, we're seeing what they studied, what they worked at. You remember, on average, it's 10 years of work experience. And what we're seeing is 1,600% more in data leaders, full stack engineering, head of growth, front-end development leaders. And this is the future talent that's building the next companies that are being VC backed. Now, at the same time, we see 50% more funding for portfolio companies with technical founders. So that's actually comparing across all the companies that we have in our portfolio. And then we're also seeing a higher, 60% higher valuation for portfolio companies with technical founders as well. Now, I think the natural conclusion is technical founders build tech giants, and that's kind of what we're building towards. Now, what drives this change? We'll walk through that. So that's kind of what the data shows us on a US-Europe level, what trends we're seeing and how it's shifting over time, and why we're so bullish on finding, with the talent sourcing, tech founders to build the next great companies. So now I just want to highlight for you 3 trends that we're seeing for the future of tech founders. As I mentioned earlier, we've got the talent that we do. This is kind of the different buckets and the different sourcing that we do. And the tech downturn that's happened recently in the past 2 or 3 years has actually accelerated our applications. We've seen more than double applications here in the UK. And we're seeing it from companies that you probably recognize. And so we're seeing 4 times the number of founders from companies that are undergoing restructuring. And what this means is they have a VC-backed background. They know what high growth looks like. And for a lot of people, this is a great time to build their next company. And this effect is also more pronounced with technical founders. And so we see a huge increase in all founders following restructuring, but a 9x increase in technical founders following restructuring as well. So this means that technical founders are looking to build their next companies even more so than commercial founders. Now, cycles happen, obviously, in VC. You can see historically the big changes here. We're obviously in the midst of a new cycle with AI. And again, like what Andrea said, super bullish about the future in terms of the companies that are being formed now and the opportunity for impact. And obviously how much less it costs to build a company, and then obviously the ability to make a much bigger impact than even just a year or 2 ago. So why we're excited about the future of European tech? European tech has historically struggled to produce a steady stream of tech giants, obviously with the tech founders that we're recruiting, the big changes we're seeing across companies, and with restructuring. And then the next generation of founders appear to be different, given that majority of them are technical as well. So there's 3 trends I want to highlight for you, and I'll give you some example companies in our portfolio. The first is, and this is more unusual, compared to where we were 5 years ago, is CEOs with a tech profile. And so experienced founders are both CEO and CTO. And as an investor, there's a usual kind of counter argument to this, which is how do you fundraise and build a product at the same time? And the answer is you can. You need to have a plan for it. And I'll give you one example. This is RoboMinder, one of our companies in the portfolio. They're using computer vision to do AI-powered insights on robots when they fault. And so it's a team with a 2 tech background. So they have a CTO and a CEO with a tech background. And they've gone on to raise after Antler's round. And you can see they've gone on to make a significant progress, working with Boots, specifically on the robots on the factory floor. Second example of a trend we're seeing is deep domain expertise. So these are co-founders that really have a deep understanding of a problem area. Good example here is CFDX. 2 PhDs from Cambridge, Ravi, who you'll hear from in a bit, AI neuroscience company. They have a background in phospholipid testing for the early detection of cancer. They're applying this to dementia and hoping to solve and crack Alzheimer's. Imagine if you could treat Alzheimer's from your 20s or 30s with looking at biomarkers and being able to develop new drugs. Quite exciting, huge bet. This is a team that's worked in the space for many years and obviously very confident in their ability to apply that to a different problem area. And then a third example is co-founding teams with longer runway to traction. As an investor, this is something you always see, which is what is your commercial traction? What is your revenue? What is your plan? Well, also it requires being patient at times. Good example of this is Mast. You'll hear from Russ a bit from CloudCycle. We talked about it took over 2 years to get to revenue. That happens for deeper tech companies. Mast is an example of a company that has cloud-native mortgage origination technology to help with the onboarding of applicants for mortgages. Rob, who's one of the co-founders, had a deep background in this at Barclays. They had a CEO and a CTO, and it took them about 1.5 years to 2 years before they got their first revenue. Now their average customer contract value is over £1 million. Took a while to get there, and particularly if you're targeting larger businesses and enterprise-scale customers, it's a longer sales cycle. And as you hear from CloudCycle, similar story. But on track, confidently for raising a Series A later this year. Great. So that kind of covers the key things on dynamism. I hope that makes more sense in terms of how Antler plays a part in that. The big trends we're seeing with European tech talent and how that's playing out with the companies that we're backing. And then, of course, lastly, our flexibility as an investor, seeing these big changes that are happening at the company level with how we look at the profiles of founders and the backgrounds they have and how to take advantage of that and how that all adds up to dynamism. Got the slide again. We're going to take a short break, and then we'll be back for the quick fire round pitches. See you guys in a bit.
All right, good afternoon, everyone, and a very welcome back. If everyone could take their seats, we'll move on to the next section. like I said, good afternoon, everyone. My name is Sarah Finnegan, and I am one of the investment directors at Antler in London. It is awesome to see a lot of familiar faces and a lot of new ones. So welcome everyone to Antler and to Google today. So I hope you've all enjoyed the first part of the afternoon today. I think just moving forward, what's really up next? And I think, personally speaking, the seat that I sit in the most on the portfolio side, this is going to be the most exciting part for me. I think the portfolio company showdown, just a little bit of background before we kind of jump in. This is where we've invited a select group of our portfolio companies that we've backed in the UK. Before I tell you a little bit more about the format of the session, just to really briefly set the scene, you've already heard from Andrea on the impact and how Antler has been a driving force of change in the UK. In the UK alone, we've invested in over 100 companies across many different sectors, so 35 industries in the UK. The companies that you'll hear from today, they operate in a wide range of sectors, so you'll hear from companies solving in the fintech space, the health tech space, climate tech, consumer, and the list goes on. Most of the founders that you'll see on stage as well emerged through our UK residencies, although we have invited a select few of our direct investments. We'll start with some of our youngest companies, so those that we would have backed in June of this year, and then you will see kind of some of the more mature companies as we go through. You'll notice on this slide all of the founders in the order that you will see them pitch. With the red dots, those indicate that they're actively fundraising, and those with a blue are preparing to raise, so those that are gearing up in the next few months. Now, let's walk through the format. I think for the brave founders that will be gracing the stage today, each company will deliver a 90-second elevator pitch, and we'll give you a glimpse into the exciting problems that they're solving, the markets that they're operating in, and the talented teams behind them. After the pitches, we will have a networking break. So again, feel free to connect directly with the founders. We'll also have a QR code on the screen, so you can kind of, again, learn more about the companies and then connect directly with the teams. So without further ado, we'll be handing over to our first fearless founder. His name is Ernst, and he's the CEO of Bancora. So Ernst, please take the stage.
Hello, I'm Ernst Dolce, so I'm the CEO of Bancora, and you will have the pleasure to start with me, and let's go for it. So at Bancora, it's very simple. What we are doing is saving millions to financial institutions and make them more efficient. So why we want to do that? Because the banks, asset managers, they are wasting time and money processing a lot of documentation. I'm talking about complex documentation. I'm not talking about your invoice. I'm talking more about derivatives transaction and so on. So more important, their post-trade processing, it's after the transaction happened, is totally crippled by legacy tools, obsolete tools. I want you to remember just one figure. Last 10 years, more than 900 billion has been lost in terms of fine by financial institutions due to settlement failures. That's kind of magnitude of issues that we want to solve. Obviously, I'm not the only one saying that. You can see on screen that a couple companies are talking about themselves. So what we are doing, very simple. We are removing all the manual processes from pre-trade, but also post-trade. Pre-trade because that impact the post-trade, and post-trade is where there is the legacy tool, and is where there is the money to make, to be honest, as you are investors. So why we want to do that? The behavior has changed, technology obviously, but if you work in finance, it's very good. Regulatory is not something that you like. I was a trader, head of trading of AXA, managing 300 billion. I get fines sometimes, not really cool, but the regulation is pushing you to take action. So that's also a good trigger. That's a big market. I will go to talk about my team. So we are tech people. So I was a geek a long time ago, started 20 years ago. And after that, I moved to finance. But I'm an engineer. And I work with Nick, that was becoming the CTO of AXA, that resigned to join us to build the company. And also I have Ziad, that from machine learning. So traction. So we started in June, but currently we are doing all the pitch, demo. We have an MVP, but more important, we'll be generating 200K by the end of the year. So join us, invest in us, and let's make a difference.
I'm Sarol. Hi, I'm Sarol, the CEO at TradeStack, and we automate office admin for trades businesses. What do you think this line shows? It's not the River Thames, and it's obviously not NVIDIA's share price. This is the index for productivity in construction, a flat line that shows a shocking stagnation over more than 2 decades. This productivity crisis manifests in all sorts of different ways. I know this because I've worked in the industry for more than 6 years. For trades businesses, the lack of productivity comes in the form of abundance of office admin. For every job they do, up to 4 hours of office admin gets created. They spend time on lead vetting, followed by 2 hours to prepare a quote, followed by scheduling, invoicing, and payments. This is work they're not getting paid for. TradeStack's AI employees is facing this head on. Our first AI employees helps painters and decorators quote 80% less effort and 20 times faster. We've been tried them by hundreds of painters since April this year. Now you might have a better idea of what this graph shows. Growth. So this shows our growth over the past few months. We've grown significantly, and in less than 6 months, we've done more than 300 quotes valued at more than $500,000. Our team's experience across construction, AI, and sales has been our biggest enabler for growth, and we're just getting started. So do let me, Vaibhav, and Alex know how you would like to join the journey. Thank you.
All right, I've got 90 seconds to talk about one of the most hated professions, often cited below parking ticket wardens. Recruiters. I was a recruiter at the age of 18. I'm a second-time founder in this space, and I've spent the last 12 years building and selling technology to recruiters. My name's Cameron Briggs. I'm CEO of Venti AI. Recruiters spend over 5 hours every day on highly manual sales processes, and business development was recently listed as the #1 problem for recruitment agencies. It's the first time it's happened in a decade. And the current process is horribly manual. It's painful, fragmented, completely inefficient. It needs an average of 5 different tools and ultimately is pretty painful for recruiters. Venti has the early mover advantage in this. So Venti is something that we're building to solve a problem that we've actually faced in our everyday life. It checks hundreds of sources for matching jobs. It checks and understands thousands of job descriptions every minute. It pre-researches leads and uses AI in that process, and it identifies hiring managers that recruiters can sell to. And we've had some pretty good traction so far. So in just 2 months, we've secured 24 paying customers with 16K ARR. Most importantly, we've had no churn at all. And 2 weeks ago, we closed a round that included RecTech angels, recruitment founders, even our own customers. And we're 3 friends, ex-colleagues, ex-recruiters, and second-time founders. We've worked as a team before, we've solved this problem, and we have deep domain expertise. So, if you're interested in what we're building, we'd love to chat further. Thanks for your attention. We're Venti.
Hi everyone, my name is James. We are creating the next sustainable smart farms with AI-powered insect rearing. So, not many people know that thousands of people die every year from pesticide poisoning. That's pesticides that goes on the food that you and I both eat. As a result, farmers are trying to find different ways of managing their pests, and a great sustainable alternative is beneficial insects. These are bugs that farmers actually buy and release onto their farms to kill their pests. But unfortunately, there's still a bit of problems with beneficial insects, and growers are still reverting to pesticides. Number one, they're very expensive. Number two, actually getting your insects is a very long and unreliable time process. And as a result, this causes crop losses during the wait periods where pests are just left to roam on your crops. So these ghastly things are things that growers are actually now currently using to rear insects themselves directly on their farms. But unfortunately, as you can see, they're pretty homemade, and growers don't really have the expertise to actually make them work. So this is where we come in. We've created smart insect rearing incubators, which monitor insects inside. We use computer vision and AI to detect our insects. And what this really does is it eliminates any expertise that a grower might need to rear insects directly on your farm. I've got one right here. I thought I'd have another hand, but I don't. This is an example customer that we're currently piloting with, Hulo. They actually supply all of Wimbledon's strawberries. They spend 150K every year on just one insect species, and they might be buying 3 or 4. With our system, we can save 50% of insect costs. We eliminate that pest control time and have instant insect access, and therefore we also eliminate the associated crop yield loss. The market is actually a lot bigger than people think. In the UK now, the #1 imported commodity by unit are actually beneficial insects, and the sector is set to grow rapidly as pesticide regulations keep coming in and basically keep forcing growers to switch from pesticides to beneficial insects. These are 4 farms that we've been piloting with this year. We've demonstrated that our computer vision works, and now we're currently raising to scale this technology to convert at least one of these pilots next year for over 60K IRR. Thank you very much. Yeah, if you're interested, we're happy to have a chat. Cheers.
Hi, everybody. I'm Vasil. I'm the founder, co-founder and CEO of Distillery, and I'm here to talk to you about data. Now, millions of companies spend over $100,000 on building and maintaining a data stack, and in the mid-market, it gets up to $500,000 a year, and that includes getting people to maintain that. Now, that's crucial for getting timely customer insights, making business decisions, and capturing revenue. There's 2 options. You either build this manually, or you choose pieces of each of these 3 layers to build your own data stack. Now, even then, you still get missed revenue opportunities. We've experienced this ourselves. I've gone the manual route. Edward, my co-founder, has built data stack supporting over millions in ARR, and we've got brilliant minds eager to join us that have been helping us so far. Now, newcomers in the space, quite often, and in most cases, what we've seen is they focus on AI native BI. Now, those solutions still depend on data warehousing and ETL tools that need to be maintained by people in the company, even though they have this AI native BI. What we do is we provide a unified solution that is AI native across these layers. And with this, we effectively automate this maintenance. Now, how we do it is our platform connects directly to the raw data and to the business context above that, and is able to automate the setup and the maintenance of the data stack and allow for capturing revenue opportunities that you wouldn't have been able to capture before as you have data available immediately. Now, in numbers, what that means is the setup is 10 times cheaper, you get no maintenance, and you get 25 times faster to insights as compared to a regular data stack or the manual approach. Again, that means captured revenue opportunities where you would have missed previously. Now, we went from prototyping, and 12 weeks after that, we got our first paying customer. We're building quite quickly, and At the moment, we're saving our customers tens of thousands of dollars and days of work. Scan the QR code to chat with me on WhatsApp, and I'm eager to meet you all. Thank you.
Hey everyone, I'm Pete, and I'm the CEO at Falco. Compliance is a critical backbone function of financial services firms, but there's a huge problem. 60% of staff in compliance teams are burnt out and actually quitting the profession for several reasons. There's too much regulatory change, too many fines, and quite frankly, too much manual, mundane work. It's time to transform the way that compliance work is done. Meet Falco, your digital compliance co-worker. Falco executes entire workflows, freeing up freeing up time for compliance teams. And we've initially focused on regulatory research and horizon scanning as use cases. With Falco, users can ask any compliance or regulatory query and get detailed responses with regulatory citations for every single sentence. They can also leverage tools for horizon scanning, analyzing specific regulatory publications, and also tailoring responses to the license information of the specific firm. At Falco, we're combining my 15 years of domain expertise in financial services with the product and tech expertise of my co-founder Ez. So far, we've had over 150 users from leading financial and professional services firms sign up for Falco. If you're interested in learning more, scan this QR code and let's chat about the future of compliance.
Hi, I'm Mohammed Ghaffar, and I'm excited to introduce you to Grid Energy. I'm the co-founder and CEO, and I'm going to talk to you about solar. So, despite record increases in home energy bills and increased uptake in solar adoption, it's still on less than 5% of roofs in the UK. And that's because 80% of homes can't afford the upfront costs and the long payback period. The traditional solar ownership model is broken, and Grid is changing that. We're building the smart solar network to deliver the UK's first true solar subscription at scale, starting in new builds. We have experience 20 years designing energy infrastructure on large-scale projects, delivering thousands of new build homes, as well as building climate tech products and disruptive consumer brands across our founding team. And this allows us to unlock the huge $2 billion a year new build market that is currently untapped, where right now developers have a pressing regulatory why now that they have to meet, which is causing them to spend more money, and they're getting squeezed margins on their houses. So they're desperate to work with us. And what we do is, partnering with them, we fund, deploy, and operate smart solar and battery systems onto new homes at zero cost to homeowners and developers. And we also optimize all of the energy at the home level and within our network to benefit the homes and give them greater savings and support the local grid. And we're live on our 3-home pilot, which subscriptions are active on now. We've got 300 homes committed for next year, with thousands more in the pipeline. And we're ramping up to scale to 30,000 homes in 3 years. And to date, we are backed by great investors who have joined our pre-seed round. And we've also secured a debt term sheet from Triodos Bank for commercial rollout on our CapEx next year. And we're currently hiring a head of sales, and we have a small amount of allocation left on our pre-seed round with EIS available. So let's connect, and thank you so much.
Hi everyone, my name's Saif. I'm the CEO of Boxhall, and we're building an automated marketplace for road freight. There are high levels of friction in the road freight industry, especially when a shipper wants to transact with a new carrier. So we're building the Boxhall marketplace to seamlessly enable shippers to transact with carriers. Both parties have all the tools they need to transact in a self-service way through the platform. Bookings can be managed through the platform. Payments are handled automatically through our integration with Stripe. And we're also offering financing services to both shippers and haulage companies, which we are looking to automate in the future. So we've already enabled shippers to reduce their cost on logistics, on the carrier spend. At the same time, what used to take a couple of days or even weeks to when a shipper wanted to transact with a new carrier now takes a matter of minutes. On the other side, carriers are able to identify high margin loads, as they can see all the loads on the platform, which only take them less than a couple of seconds to offer a quote for. We've had consistent growth of carriers on our marketplace throughout our journey from day one, and this has enabled us to kickstart transactions in January 2024. Since then, we've had multiple cohorts of shippers transacting through the platform, which suggests that we're on the right track with the features we're rolling out. The market size for the road freight industry globally is around $1 trillion, and by focusing on automation of a marketplace, we believe we can achieve a high margin potential. The team is made up of myself with over 10 years of experience in the logistics industry, as well as being a past founder, along with my co-founder, Franco, who has experience in full-stack engineering for over 10 years at companies like Universal Music and the London Stock Exchange. So if you're ready to help us automate freight, please get in touch. Thanks.
Hi everyone, my name is Jules and I am the co-founder and COO of Blend. We are on a mission to train, retain and engage the next generation of deskless workers. Now, can I just ask the audience, can you please raise your hand if you work from a laptop or a computer at a desk, whether that's at home or in an office? Okay, awesome. So that's the majority of this room. But did you know that we are actually a minority? Because 80% of the world's global working population are considered deskless. Now, let's take UK hospitality, which is the initial market that we launched in. Since COVID and since Brexit, a shortage of trained staff is costing the industry significantly, and employers are having to turn to the next generation, Gen Z, to plug this gap. Now, the problem is hospitality onboarding is a highly costly and repetitive process. It's typically done in person by a manager, supplemented with paper-based training documents. It is not digital, it is not trackable, and it is absolutely not fit for a modern generation. Because how do we consume our information these days? Typically on our mobile phones. And how is that information typically presented to us? In short-form video content. So why are we still trying to train people on paper? So we spotted this opportunity to innovate deskless training. Introducing Blend, where TikTok meets workplace training for deskless workers. Our platform allows operators to train, test, and track their workforce much faster, saving our typical customer over 50K annually. How are we doing it? We are blending user-generated video-first training content with an AI-enabled microlearning platform designed to make training much more fun and engaging to a modern and mobile-first workforce. And we are live across some of the UK's top hospitality chains. We've got some amazing early customers and amazing feedback, and we are ready to scale. We've got the best team, and this is why we're the best blend for the job. Jonah is a previous expert in video-first production. Helen is a previous VC-backed founder, and she is a self-taught no-code developer. I have direct deskless onboarding experience at Uber Eats, and I've scaled high-growth companies in global markets, and we want to scale 10x in the next 10 months. So we are looking for advisors, partners, and of course, investors. Great news is we're currently in the midst of a funding round, and we still have EIS availability. So if anybody wants to get involved, please come and find me afterwards, and together we can reshape the future of frontline training. Let's get blending.
Hi, everyone. I'm Jonas, the CEO of Shaka. Revolut, the Europe's biggest super app from not from mobile plans, not yet, but from banking all the way to insurance products. And did you know that they also offer roaming eSIM so that you can avoid excessive roaming charges when you travel abroad? And they're actually betting big on mobile. They reached out to Shaka to help them set up local mobile plans across all of their geos, more than 30 countries all over the world. I mean, good luck to Revolut if they want to go and do it themselves. You're looking at several years of negotiating with local mobile operators, and you're looking at millions of pounds that you're going to spend on integrations. With Shaka, you can do all of this today and for absolutely no cost. Shaka is a global API platform that sits between the global telco infrastructure and brands and businesses. Think of it as Stripe for mobile. What that means is that Revolut can easily embed mobile plans straight into their product. In the same way they embed insurance, in the same way they embed banking. The time to disrupt telco is now. With eSIM entering the market, the traditional distribution value chain of physical SIM cards is being flipped on its head. We are the right team to do this. We built businesses in the past, we sold businesses in the past. We have a combined experience of 20 plus years across telco and tech. While we're still waiting for the Revolut deal to close, we have had some other major customer wins. Sidemen, anyone? The biggest creator entertainment group in the UK with over 30 million supporters. Deal, the global HR platform with over 35,000 global business customers. Well, that's it. If you're interested in more, please reach out and scan the QR code to get yourself a free unlimited UK plan from one of our customers that we just launched last week. It has unlimited data, unlimited SMS, and unlimited calls. There's only one available, so be quick. Thank you.
Good afternoon. I want to introduce you to Genesis. Our vision is actually to manage the world's costs, but we're going to start with bookkeeping. And AI is what we've built. The problem with bookkeeping is that it's a $90 billion industry where 92% of it is paid for by human cost. The average age is 54. There's over 400 million hours that need to be replaced each month within the next 5 years. And the lack of juniors. I would ask you, have you seen someone on TikTok advertise or recommend someone become a bookkeeper? And that's part of the problem. So our objective is to move the role of the human that does need to stay in the place from an operator to a validator. Now, our solution is a self-learning multi-agent architecture that is contextually aware of what someone has spent company money on. This is not a API wrapper to another big AI service. This is something which is our IP that we've built over the last 2 years. How do we charge? We charge per hour. This is a different business model, but we secure 3.5 times the revenue that a tool that we replace actually gets right now. And this is our waitlist growth. This is a photo from April this year. This was an inflection moment for us, where we were supposed to get 20 people to our very first public demo at one of the biggest conferences in the industry. And this is where we're sitting with just over 5.5 million on the wait list. We've now passed 30,000 clients from 220 practices. But that's a wait list. We've been working with early adopters, and this is our traction so far. In the 6 weeks from September the 9th, we are onboarded 25 clients. We have a client live in the USA from March, and Australia from Feb. And that is our deferred income. We will start billing this on the 1st of March. Thank you so much. Afternoon, everyone. My name is Enrico Faccioli. I'm the CEO and co-founder at CData. Thanks for having me. And we're going to talk about cybersecurity today. So we're specialists in cyber deception, and we help large corporates such as Ely, Leroy Merlin, Tokyo Marine, White Bread, and many others to detect attackers early in the chain. My co-founder has been in cybersecurity for over 30 years, and although things have improved, most companies still find out they've been breached way too late, which leads to very expensive data breaches. And this is why we've been building our cyber deception platform over the last 3 years, where we deploy traps. Inside of our customers' environment, think of fake servers, fake cloud services, fake credentials that have no real business value and therefore should not be receiving any interaction whatsoever. If we do receive any interaction, that means you're likely having already a bad guy inside of your network, and so defenders can remediate quickly with low false positives. Now, most recently, our customers have been increasingly worried about deepfakes. You might have seen in the news as the latest threat actors are doing. And therefore, we've now brought to the market a second product where we do attack simulation against our customers' employees to monitor and understand their deepfake susceptibility and then train them to reduce risk. We've got already several POCs undergoing with early adopters, including FTSE 100 customers. Thanks for your attention, and let me know if you want to chat more. Obviously, I don't have a QR code here because we're a cybersecurity company, and QR codes are inherently unsecure. Thank you.
Hi, everyone. At CloudCycle, we make concrete better. $54 billion worth of concrete is delivered out of tolerance every year in Europe and USA. And it's no surprise why, because we only test 1 in 20 loads. So if you have a house, the slab probably wasn't tested for quality. Now, why don't we just test all the concrete? I mean, it seems like an obvious decision. Let's see if this plays. Next button. Yeah, there we go. So this is a slump test. This is done everywhere in the world. It takes a long time, takes people on site. It's dangerous, it's expensive, it's slow. The data quality is actually really poor, but it happens everywhere. While he's doing this test, that truck's waiting in the background mixing. If this test fails, that truck will be rejected and it'll be replaced with another truck. The supplier loses the money for the wasted concrete, and the contractor wastes time. So this is the slump test right now. He did all of that to measure this. How far this concrete slumped down, hence slump. So we automated it, basically. We made it 3,000 times cheaper. We made it instantaneous. And so we have proprietary hardware on the trucks. You would have seen me with that briefcase. It's full of our kit. We fit that to the trucks. We've got ML algorithms in the cloud, and they do all the heavy lifting. We provide our customers with a dashboard that they use to reduce concrete waste and cement contents. There's 4 major players in the ready-mix industry. We're working with 3 of them already. And everyone likes hockey sticks. We've got 2 of them. The one on the left there, that's our fleet. We charge per truck per month for that, and we're at 334 trucks at the moment. Our current customers have 24,000 trucks, so we expect quite big growth. We haven't monetized the plot on the right. That's the volume of concrete we measure per month. Right now, it's 135,000 cubic meters. Our customers currently do 142 million cubic meters per year. So there's a lot of growth there. Now, I'm going to stop there and say, do you want to help save 1% of global carbon and make some money? Because I do, and we're raising.
Hello. So this one. Hello, I'm Richard, the founder and CEO of Pickles. I love dogs and cats, and I'm sure I'm not alone. At least I hope I'm not. Did you know around 70% of Gen Z would rather have a pet than a child? More people are getting married later, having children later, or choosing not to have them at all. As a result, pets are becoming more than companions. They're becoming beloved family members. But here's the problem. This growing love for pets is clashing with the outdated state of veterinary care. Many vet practices are run down, understaffed, and most importantly, lack the human touch. Prices are skyrocketing due to inefficiency and lack of competition. In fact, the CMA is doing a big investigation into this. Vets used to be the trusted source for everything pet-related. They would be the gateway for advice and products, but today vet companies are struggling to innovate and focus on the customer needs. Pet owners are frustrated by this, looking elsewhere. They're turning to fragmented solution, products that aren't always effective, and in some cases, outright scams. The result? Many pet parents go to the vet only when they absolutely have to. But this isn't what customers want. Pet parents want a seamless, united experience, a service that understands them, and a place that cares for them in the same way that they care for their pets. At Pickles, we're doing something hard, but incredibly important. We're not just a tech company, we're building in the real world too. We're reinventing pet care from the ground up. And we're creating a brand that fosters strong relationships with pet owners, earning their trust to be one of the most important relationships in their pets' lives. And that's just the beginning. Think about all the excitement and opportunities we've seen in the human medical field. Longevity research, AI breakthroughs, and personalized medicine. But in human healthcare, these innovations often struggle because they're heavily regulated and they're in legacy systems. At Pickles, we're free from these constraints. We have the perfect environment to make groundbreaking ideas a reality. Imagine if bringing your pet to Pickles meant they could live longer, healthier lives. And that's not just a pipe dream. We're making it happen. Right now, we're using AI to deliver critical test results within 2 hours, not days, and leveraging AI to automate admin tasks so our clinical teams can focus on what really matters, your pet. And there's a lot more to come. We're seeing incredible early traction with over 2,100 members. We're at a £1.5 million run rate, and we're growing 11% month on month. But most importantly, our customers love what we're doing, with only 5-star reviews and glowing reports coming from them. If you love dogs and cats like I do, and you're excited about what we're building, come and talk to me. Let's build the future together.
So Alzheimer's disease has been the leading cause of death in the UK since 2016. Now 6 in the US and China and 7 in the world. The gravity of the problem will only continue to increase. But 2 main features plague our ability to direct and understand this disease. The first is poor and inaccurate diagnostics, and the second is ineffective therapeutics across the board across the past 100 or so years. And there are 3 main reasons for that. The first is that patients with symptoms typically get symptoms decades after disease onset. The second is the lack of tissue biopsy means that we have no fundamental ground truth information or understanding of disease biology, and animal models generally are flawed elements of studying disease biology as well. So CFDX is a moonshot for precision neuroscience. It's our goal to build a molecular level understanding of the brain across human health, age, and disease. By working with clinical collaborators across 4 continents, we generate our own biological multimodal data sets and train advanced AI models across multiple different categories to develop next-generation biological insights in this space. There are 3 broad applications for this. The first is our immediate focus, which is better and more accurate diagnostic tools and devices. This allows us to molecularly reclassify disease and tackle the disease at the earliest symptoms. The second is unlocking and unraveling early mechanisms of disease biology that can allow us to predict new drug targets. And the third is iterating and testing on what we develop in live clinical sandbox environments across multiple sites in the UK, starting with the University of Oxford. I like to think my role is kind of important, but certainly my technical knowledge is wholly insufficient. I'm an former NHS clinician, PhD in neuroscience with 7 years of parallel investing experience, but it's our team's expertise, deep technical expertise across every single domain of building our moonshot that gives us the permission to build in this space. We're pretty excited about what we're doing. It's pretty high risk, but we think this is the way you will solve generational outcomes in the neurodegenerative space.
Let's talk about the sports opportunity of the 21st century, motorsport. Did you know that out of more than 1 billion motorsport fans, 300 million of them hit the track themselves? That can be in real-life racetracks, in go-karting, or in racing games. There's a problem for those 300 million drivers, though. They don't know how to get faster. And that's because of a trade-off between advice quality and affordability. On the one hand, you can get cheap or even free advice through, let's say, watching YouTube videos, which obviously never personalize to what you are doing wrong. On the other hand, you could get a coach, which is incredibly expensive, and get highly personalized advice. And we at TrackTitan are solving that trade-off problem through AI-based driver coaching. We have built a platform that takes a race car's raw data, streams that to the cloud, and then gives you automated tips on how to improve, like in this case, how to optimize your racing line. We're a London-based team of 9 at more than 400K in ARR and backed by some great investors such as the car manufacturer Porsche and, of course, Antler. And I'd love to tell you about why we care so much about helping drivers improve. I'm Max, the founder of TrackTitan, and I'm a professional racing driver and coach. Besides that, I worked in 3 VC-backed startups before this and always thought to myself, why on earth has no one yet disrupted this massive sport that I love and care about with technology? And that's what led us to start TrackTitan. And clearly, something about it is working, as we have grown to now more than 5,000 paying subscribers and starting to grow faster and faster. And this is a big opportunity, of which we're merely scratching the surface. We started with coaching racing game players. That was step 1. We're now branching out into the real world and already testing that with real-life race car data, such as from Formula 1, before going after a $10 billion opportunity, which is road learner driver coaching. So if that sounds exciting to you, let's have a chat today. Thank you.
Hello, I'm Aaron, CEO and co-founder of Hydrologic. So we make hydrogen the easy and immediate replacement for diesel-fueled off-road machinery. So these are things like generators, excavators, forklifts used in industries like construction, film and TV, festival events, mining, etc. And globally, this machinery is a huge polluter. It's creating 2.6% of our global carbon emissions. And it will be moving to hydrogen because hydrogen will cost the same to use as diesel in these use cases by 2027. So economically, it will be both the best choice, but so too will it be environmentally. And the supply chain is being built at the moment, whether that's from the fuel transport, the machines, or the end operations. However, there's a problem in that using this chain is hard for both the fuel suppliers and the end users. And we've got the solution, Hydrologic OS. So it's our patent-pending technology platform that's both software and hardware to deploy hydrogen at scale. The software is there to plan, manage, and monitor both the operations and the assets for those end users and fuel suppliers, while the hardware integrates any hydrogen compressed storage gas solution with any piece of machinery, providing the monitoring needed to optimize and manage all of that. And it's not just me behind this, we've got the best team in the industry doing it. And together with our team and platform, we're driving the market. We've 3 times our revenue growth in the last 12 months, with top-tier repeat customers, names you'll recognize, and building a strong pipeline of customers who, what I get excited about, are co-developing the products they want to see with us. And that's led us to be named a top 10 innovator in hydrogen by Sustainable Ventures. And they're not even one of our investors, so they don't need to say that. So we have the foundations in place. We've got the right product, the best team, trusted brand, and those leading users. And what we need is your help to help us end diesel. So we are raising, but if you just want to find out about hydrogen, please come talk to me afterwards.
Three more to go. Hang in there. Hello, this is Erdem. I'm a co-founder and CEO at Flola. So if you're a tech company or a service business and you're offering a complex solution, your kitchen probably looks like this. Think of your client-facing team. They're doing demos, sending proposals, sharing resources, email back and forth, post-sales, implementation projects, further onboarding resources. We at Flowla make sure your dining room remains as peaceful as this. Happy customers, zero friction, and full visibility. So meet our client portals. They are step-by-step journeys designed to unify your buyer's experience into one beautiful link. Both the resources they share are in there, decks, documents, videos, and the actions they expect back in return, keeping up with deadlines, collecting information, signing documents. It's created automatically and instantly personalized for your buyer. If you're a big picture person, think of your CRM, and then Flowla is its client-facing extension, living, breathing through the buyer's lifecycle, unifying all stakeholders into one page, and then syncing all that activity and insights back to your CRM for data-driven decisions and, most importantly, automations. So if you think this is smart and you should have it, you're not alone. We launched 2 years ago, and we've been growing the community of our happy customers month over month. We're a team of 9 that have built and sold companies in the past. We raised our pre-seed January of last year. So if you're curious to experience how our links look like, scan this QR code, check out our materials, and please get in touch. Thank you.
Hello, everybody. My name is Amit, and I'm the founder and CEO of Servo. Say, have you ever had a dinner in a restaurant where you're constantly looking for a waiter to serve you? Or perhaps visited a fast food joint during your lunch break, queuing for ages and barely had time left to eat? Or had a nightmare check-in in a hotel that didn't seem to end? Sounds familiar, any of these? Now, all these inconsistent service experiences, what they do is they leave a bad taste, they cause you to spend less money, and most importantly, not to visit that place ever again. Now, I was working in hospitality for many years and saw firsthand why this is happening. Now listen to this. The #1 reason for inconsistent service is that hospitality brands are struggling, even the largest ones, by the way, are struggling to measure their service systematically. The existing solutions they use are either anecdotal, occasional, or even biased. Now, that's exactly why we've built Servo. We transform this entire business practice, allowing operators to quantify that notion of service and improve it consistently over time. We do that by tapping into the existing CCTV system, analyze the entire service in depth using computer vision, and provide the operators with a clear action plan of what exact buttons they need to press in order to improve the most important service KPIs. And these KPIs indeed seem to improve, as we're currently at £380,000 ARR, which is 6.5 times higher than last year. On top of that, we're in long-term contracts with the top brands in the hospitality sector, including Dishoom, Hawksmoor, Watchhouse, Turtle Bay, and many others. Now, next to that, if I look at the bottom part of our sales funnel, we're currently running live trials with even bigger brands, including Marks & Spencer and Pret A Manger, reflecting an ARR opportunity of £5.5 million. We're currently fundraising, so happy to have a chat if you want to learn more. Thank you very much, everybody.
Hey, I think this is the last one. I'm Ferdinand, CEO of CypherX, and now we're going to talk about body art. So when I think of tattooing, I think of a process that's not quite easy. So I think of blood, pain, needles, hygiene, scars, tedious aftercare. And at CypherX, we want to change that. So we have created a technology that allows for convenient and safe tattooing without pain, no blood, no scars, no aftercare. We built this technology on microneedles that deliver ink into the skins within minutes. And you can think of this, each microneedle is basically a pixel of an overall tattoo image. Tattooing has gone from subculture to popular culture, with about 30% of young adults having a tattoo these days. And our technology really caters to the need of increasing safe and convenient tattooing. Initially, we want to launch our product at festivals on the ground, and then later launch it online, direct to consumers, where people go on our website, they design their tattoo, they get it at home. And you can think of this similar to print-on-demand websites. We have achieved various key milestones at this point. So we have built a fully functional prototype, which you can see here on the slide. I'm also happy to announce that we have started our user testing. So you can see one of our users proudly presenting their tattoo on Instagram. And the next big step that we are tackling at the moment is scaling our production. There's a strong team behind this technology, so it spans medicine, material science, and product design. And if you want a tattoo, feel free to scan this QR code and become part of our trials. Thank you.
Everyone can breathe now. Thank you very much to all of our founders for pitching. 90 seconds is always an interesting format. We have a break coming up, so 15-20 minutes until our next section, which is a panel discussion featuring some really, really awesome VCs, which will be moderated by one of our venture partners, Hannah Leach. So please grab a drink, connect with the founders and your peers, and see you back at 5.
Hi, everyone. Thank you so much for being here at now gone 5 p.m. Just to get everyone excited, we thought we might do like a whoop for UK Dynamism, you know, just to like, everyone want to whoop? Should we whoop on 3? Who wants to whoop?
I feel like you're joking.
No, I'm not joking.
Okay, good.
We need it right now.
Sound like I'm
People need
joking.
to stand up, I think.
Yeah, so let's stand up.
A full body whoop.
Let's
yeah.
stand up.
Yes.
I'm going to do a whoop. Okay, 1, 2, 3. Whoop! Okay, so I feel like the conversation is only going to go downhill from here. So
Hey, there's some of us who don't want to be the 53rd state.
I'm just saying, all right? Okay, so thank you to you guys, Neil, Zara, Hussein, and Toby, for joining us. I think this is going to be an exciting chat. 2 Americans, a German, and a Brit. Let's see how that goes. So, American Dynamism. Everyone know the term American Dynamism was coined by A16Z recently to talk about investing in companies and supporting companies that were supporting the national interest. And Giant Ventures, if people know Giant Ventures in the UK, I'm actually just going to turn. Recently talked about something called British Dynamism, which is basically talking about how we can introduce mechanisms to really support UK tech. So we are going to kind of dig into that concept of UK Dynamism. And obviously my whooping was to bring some excitement to the conversation to start, given there's been a fair amount of naysaying of late. So on that note, what are we most excited about when it comes to UK tech and venture? Anyone can start. No, don't all shout at once, guys.
Happy to start. Look, I spent a lot of time with 2 of my favorite people in the London ecosystem, Robin and Saul Klein, right? And I'd encourage you all to go and hang out at Local Globe's offices. They've got this view of New Palo Alto and 164 unicorns within 4 hours of King's Cross, 27 million people. There's tons of exciting companies here. We've got talent, we've got universities, we've got capital. Capital isn't a problem. We've got £6 trillion sitting here in the UK, £3 trillion in pensions, £3 trillion in insurance, 300 billion sitting in cash ISAs earning a negative cash return. We just need to take that capital and stick it into late stage and into equities, and I think that will solve a lot of our problems. I work for the stock exchange. I'm naturally optimistic. My parents had a real struggle, and I think there's a lot to be excited about, and everyone should stop complaining.
Okay, strong start.
I think that I'm actually not a natural-born Brit. Don't be confused by my beautiful RP, but I think that there are amazing ingredients here. You have amazing schools, you have great proximity, sort of the global rich love to buy a bolt hole in the English countryside. Apparently Ellen DeGeneres is moving in. There's great, she's very rich. There's great ingredients, and I feel like there's either too many cooks in the kitchen or all the chefs have walked out, and I'm not sure which. But I think that quality ingredients mean that like you can make a beautiful mince pie, and so it's exciting to be here at what feels like sort of the start of that.
You don't have to answer it.
And I feel like that answer was pretty eloquent and probably pretty much what I agree with.
So, I mean, Toby, you're focused on fintech.
Yeah, focused on fintech, and we are a New York headquartered fund, global fund, investing in the US, in Europe, Latin America, and also in other parts of the world. And we've been around for more than a decade, and only 2 years ago decided to actually come and open an office in London, when lots of US capital is sort of retrieved from the UK or from Europe. I think we've sort of made the somewhat contrarian view to open an office in London, hire a team on the ground to invest in the UK and also the rest of Europe from London as a gateway. So we're super excited. We invest in financial services, and we're convinced that the deconstruction, reconstruction of financial services is not going to play out solely on the East Coast or even the West Coast of the US, but it's a global phenomenon. And I think London is really well positioned, despite Brexit, to really be the main beneficiary of that continuous trend across Europe.
So in addition to fintech, when it comes to other sectors, where does the UK currently have a competitive edge, do we think? Maybe Hussein, one for you.
And life sciences for sure, and that's just not even like tech bio, but just broadly life sciences. I think we've produced company after company in that field, and then that obviously intersects with everything that's related to tech bio, because I think the other big strength here, and it's kind of right here around the corner, which is DeepMind, which is reasonably old as far as AI companies go or AI engines go, and it's starting to produce kind of wave after wave now of companies that are kind of coming out of it as people leave the enclave of Google and kind of go off to do something else. And so those two things I think we're incredibly strong in. But I feel like the UK, because it's such a research heritage and such an intellectual heritage, has like the talent base to produce almost any kind of company. And so you see quite a bit of variety, in this ecosystem, not just in any one given field.
I mean, you just mentioned AI, which I wasn't planning to get to so soon, but when it comes to what we are doing as a country to support AI innovation and growth, are we doing enough, or are we doing the right things? Neil, you're looking at me as if you want to answer that question.
Well, I don't think we're doing enough, frankly, right? But there's some really exciting companies. I think capital has been another issue, right? To get behind these companies, we don't have our own foundational model yet in the UK. It'd be great to get really behind this. I think power could be a big unlock for this. I know some people like Barney at Clio being quite vocal on this point. I agree in that regard.
I think that there's a question of how much the UK, as in like the government, right, needs to be or should be involved in the earliest stages of funding. It is, and there's the foundational piece, right? Like the American internet was built by the American government because we didn't want Russia to go to the moon or something, right? But like they weren't trying to take equity stakes in these companies, for better or for worse, and it's worked out relatively well for America economically. But I think that so much of the time and energy in the entrepreneur groups and things that I sit in here is sucked up by, I have to fill out this form, is this thing, is the government, should I apply for this loan? Now this government pulled this loan, I have to close my, and I'm like, I can't even go to the dentist here because I can't deal with bureaucracy, much less as an earliest stage founder, which I've been, trying to start a company while also having to knock on literally every door in sequential order, at 10 Downing Street. That seems insane to me. And so I think some things are really cool, like ECIS, EIS, that stuff I think can work up until it gets in the way of saying, oh, but then you can't be a C Corp, so you can't get the early stage capital from some of the US. It is, I personally wonder if it is better for all of these amazing, great, smart founders to focus on raising money from the people who are ready to write a check over a coffee, which often are not people who are involved in the British government, and then deal with them later when you have enough headcount to have a building like this and an entire floor of bureaucrats.
So I think the issue of is the policy environment unfriendly to founders, and that comes up quite a lot. And it's not necessarily the policies for today; it's the policies when you're exiting your business. I mean, how much do we really think that the everyday bureaucracy is really hindering founders from setting up businesses and growing their businesses here? I mean, Hussein, you've been in the UK for a while now. Like, what's your perception there?
I mean, it's reasonably straightforward here to do most of these things. And the only time where I've really, so like incorporating a company here is really easy. Like, filing things in Companies House, pretty easy. Like, raising capital used to be really hard, but that's changed in the last 5 to 10 years because there's an influx of capital here, and there's a lot of people here who are willing to write the check. Raising the first check, which is usually the hardest of the checks, SCIS has made that reasonably easy. It's pretty hard not to raise the first under 50K, just given what the tax policy is. Where it gets hard and where there's friction is probably on the R&D stuff, because the R&D tax credits, the government's taken a weird policy of the last 12 months, I think largely because it doesn't have money, is to not pay this money out, even though it's kind of contractually committed to doing it. And until people really complain and raise a fuss, it delays and drags it out. So it's kind of behaving like a bad government in that sense. If it doesn't want to pay it, it should just say, we don't have R&D tax credits anymore, and let the public kind of have the outroar or kind of discussion around the table. But it doesn't do that, just basically delays and forces you to do 10 times as much work as you need to. And then it's probably on the late stage capital side where it's actually really quite pronounced in terms of being able to raise a ton of money. But in general, I'm with Sarah. As an American, I generally believe in less government versus more government, and let kind of the markets figure it out. If the nanny state kind of gets out of the way, you usually have a thriving system that can kind of pick up the pieces. It's usually when the government kind of comes in and interferes and adds all kinds of friction to the process where actually things get kind of mucked up.
I mean, I do think that people get too carried away in the negative story. And I was at an event in Berlin last week, and the glorious people from Invest Europe were there, telling some stats. And one of them was that in Europe, UK leads in terms of money raised at 24 billion, and the next largest is France at 18 billion. And then the BBB were saying that the UK is the third largest market globally for number of deals done. And actually in terms of early stage, I mean, we'll get onto growth in a minute, but in terms of early stage, they're increasing their number of first-time deals by 64%, which is ahead of the US and ahead of other Western countries. So we're actually doing extremely well, and I guess I say that because I'm British, and we're here with Antler UK, and I think that story needs to be told more because we get bogged down in the negatives. But let's, I guess, move on to the question of the scale-up capital. You've got the Mansion House reform, so you're kind of hoping to get access to some of that pension fund money that you were talking about.
Mm-hmm.
Are you guys positive about that? Is it going to take 3 decades? Is it actually going to trickle its way down to venture? How are we feeling?
I know nothing about the Mansion House reforms. What I do know is that an attractive late-stage tech deal from the UK, the idea that a pension that is barely in business in venture at all is going to move faster to get that deal done than a good growth stage fund is that's not real. That's not real. They're not going to outbid, nor should they. They're not going to be a good board member the way that late stage founders want, whether or not that's a good board member and good governance. It just, the idea that you're going to beat Blackstone and Google Venture GV and Sequoia and Andreessen and into perpetuity, and every sovereign wealth fund and multi-billionaire family office, when you're okay, please come to the...
So they can invest in the funds who are going to be those...
They should invest in the funds, but the idea that there's but they then have to go and get in line with everybody else and say, Sequoia, please take our money. We are not going to try to tell you to put it in the UK. We're going to invest in everything you do for the next 10 years, and we're going to give you a bigger check every time you come back, because the top growth funds in the world, that's how you have to pay to play.
So the structural problem that I have is it's not a capital issue in these markets. It's almost always a talent issue. And so now you have this big pool of capital that's going to allocate money to fund managers. And so you have to be a reasonably experienced LP to discern who should get that capital. We don't have that many LPs who are trained in venture in the UK. We don't have that many GPs. Like, it's a nascent industry still. It's massively grown. I'm super grateful that we have like a thriving economy, but it is still not a particularly big economy. So where are these pension funds going to find the folks? And I'll just relay a story. Like, when we were fundraising, I think for our second fund, one of these large pension groups told us, you know, we've stack ranked all the seed funds in the market, and you're number 12 on our list. And I remember in the first fund, we applied to the London Mayor's office, and they did an actual tender, like an RFP, and it was some construction company that did the tender, and then they gave us the results, and there were 61 applicants in that results, and we came in number 59 out of 61. Like, I just know that there weren't 58 other seed funds that have delivered the same returns that we have, because we're pretty darn good investors at Hoxton. We've generated a ton of DPI for investors who took 2 companies public. So you end up with these like very big processes, and I'm not so sure there's like a depth of experience to realize a tender, like for a construction project, doesn't look anything like picking the next great fund. Now remember, and I'll give one more anecdote, like so British Business Bank, which is like the big fund investment, like the big LP of record in the UK, because it's the state government. One of the folks there sat me down and said, "You are too young to do this job." Like literally in the eye, like flat out ageism. And I begged, this is for our fund one, I begged, I said, "Please call my reference." My reference at the time was Ram Shriram, who sits on the board of Google, who was the very first angel check. He said, "I don't need to do that reference, I already know." And you know, that's what unlocked the capital in my second fund. So you end up with these like very like weird cycles, because the people who are supposed to be doing the job aren't necessarily trained to do the job. And so now you get this big pool of money from the Mansion House Accords. I don't know how it's going to get allocated.
But what is the reason, I guess, what is the reason for his question? Is that a systemic issue, a cultural issue? Is it a box-ticking issue? Like, what is...
He said there's no way someone in their 30s can be well-connected in Silicon Valley. I've heard so many people in their 40s, 50s, and 60s kind of say this. And I was like, just call my reference. Like, how many people in the UK think they can pick up the phone and call the board director at Google? And my partner's reference at that time was Dick Costello, who's the CEO of Twitter. Like, how many people are putting these 2 candidates in front of you saying, call them? If, by the way, they don't pick up the phone, then that probably gives you enough signal. But if they pick up the phone and call, like, take the call, maybe we're like somewhat connected in the Bay Area. You can then kind of figure out if like we're actually like proper technologies, but absolutely not. Like, I've seen 50 and 60-year-olds who claim this. There's absolutely no way you guys can do this.
Hussein, I feel like they had to go through that to get to where they are now.
I don't think they're that much further ahead.
I don't know. They're in quite a few funds, right? And probably started by people a lot younger than you, not as well connected. But you know, I see them on so many cap tables now. Through the LP. I don't think they're as bad as they were. Do we have a challenge? Absolutely. But I think the bigger challenge is this capital not even flowing into the UK in the first place.
I bet you today that if someone came in and said, my pitch is make the UK great again, and someone else came in and said, my pitch is I'm going to make you a fuck ton of money, the money's going to go to make UK great again.
Yes, absolutely. Unicorn Kingdom does have a cute ring to it, though. It does.
I don't think these things are mutually exclusive. I think they can go hand in hand.
I mean, do we think if it's a question of talent and that none of the homegrown funds aren't, in your words, maybe equipped with the right capabilities to be able to deploy the capital, do we think that's going to lead to a greater influx of the US funds coming into the UK? Or
I mean, the US funds will go where the opportunities are. I think the one thing I'll add to the last 5 minutes is sort of the continental European perspective. And if we're complaining here, I think people on the continent have a lot more reason to complain. The successful sort of founders on the continent, the first visit for them, the third flight will be to London, always. There's a lot more capital for continental European companies, even post-Brexit, in London than it is anywhere else on the continent. So I think the UK is reasonably well positioned, but they can always do more, no doubt.
I think the GPs also come to where the money is, not just the talent.
Well, let's be clear. There is so much money in this country and in this city. It is not sitting in the government buildings, except all the diamonds and shit they stole. It is sitting in Like, it's sitting in Mayfair, it's sitting in Knightsbridge, it's sitting in, like, in August when it's too hot to be in the Middle East, it is sitting in London and then on yachts in South Europe. But like, so people come here to access capital. It's just that I have an American fund, I'm sitting in Mayfair or whatever, having coffee with somebody who's deploying from the Middle East, and like, we love your stuff here, but it's not necessarily that we're doing business here, and not that we don't want to back founders here or hire people from here or whatever, but like, the reality is that, yes, this is a great crossroads of the world, and I don't know if those LPs are feeling particularly welcome here, especially with the kind of rising anti-immigration, anti-Muslim, anti-everything sentiments. And I also don't know if, as a GP, as an American GP, like, there's just like weird esoteric tax shit that I won't bore you guys with. But like, basically the way US funds are structured as LLCs means that if you really want to do business here long term, you end up in like double taxation. And I'm like, hi, I have money. And they're like, great, pay us double taxes so that you can then invest in us. And I'm like, okay, I'm going to take my money to Portugal, bye.
I would also argue, if you look at a lot of the big institutions in the UK, they're not investing in UK tech or UK funds. They're investing in West Coast funds. You know, the pension funds, the endowments, the foundations.
Which they should, by the way, because I want pensioners to get great returns and not run out of money because they're trying to prop up some like Etonians, like whatever fund. I have a lot of opinions about public school boys. My fiance's one.
That's why you're on this panel. Yeah. Okay, so I guess getting onto the topic of Etonian fund GPs and founders, let's go there. Are we doing enough to attract the best talent to the UK? Do we have a talent problem here? I mean, again, this is an Antler event. The answer is no. But genuinely, do we?
I mean, I think it's all relative, right? I think by and large, we don't. And increasingly, there's certainly when it comes to financial services, there's lots more talent that is coming out of companies that are increasingly successful. I mean, the UK has generated more than 120 unicorns over the last 10 years, and that's way more than Germany and France combined, for example. And there's an increasing amount of talent coming out of those companies that are looking for funding. So the problem is we've got to keep them. And we've got to keep the UK attractive, both to raise money, to grow companies, but also on the personal level. And I think that's probably an obvious area where the UK can do more. And I'm hoping that we'll do more from the government rather than do less and lead to more founders leaving, which is starting to happen. It's certainly what we are seeing, and that's, I think, is the biggest risk. And that would be a shame.
Yeah, just to add to this, look, incentives matter. I think the government didn't really read the room when they put the budget out, and that's been reflected. But I think there's a ton of stuff that we can do to make sure that this talent pool is getting remunerated correctly, right? And if I compare where we are today compared to where we were last year, 18 months ago, it's night and day on the stock market, right? Big pay packages getting voted through. You're seeing a different stance from fund managers and how they're looking at pay, recognizing that actually if you've got Broadcom and Microsoft across the road and Google, that matters to your company. You've got to be able to pay your staff. If your head of sales is getting paid more than your CEO, as was the case at Darktrace, I think that's an issue. And these are some of the things that I think are getting fixed. Would we like them fixed sooner? Absolutely.
So lots of people talk about these things needing to be fixed, but then other people talk about it's an ambition problem. UK founders don't have the level of global ambition that we want to see. Is that fair?
I would pull back and say, what's a UK founder, right? Like, when you look at who's been the most successful, a huge number of amazing founders in the UK are not white British, right? They don't even like these are not people whose family was like sitting around while they signed the Magna Carta or whatever. So there are tons of amazing British founders, but you have to acknowledge that amazing British founders are increasingly more likely to look like us.
Let me ask the question in a different way. Founders building businesses in the UK.
Yes, there's so many. There's all the smart people, all the best schools. like, and ambition-wise, I think that there's a fear of failure, which if you're afraid to fail, then there's only so far you're going to go. I think there's sort of a no tall poppies, as we call it in the US, of like, you can't stand out. You can't, every time after I do one of these panels, not you, everybody else, I get little notes. It's like, you are very American. Like, yeah, that's why I go on TV all the time, because I'm good at this, right? Like, so you can't always push people down to be smaller and back and like, don't ask for that. One time I was sitting at an event that a government agency threw in the UK, and a VC was like, don't aim for exits above 100 million because most of the exits in the UK are under 100 million. And I'm like, if you're not building a multi-billion-dollar company, like, don't talk to me. There's such a gap there, but it's not necessarily coming from the founders. I think it comes from like everybody else in the ecosystem.
Making money is a taboo here, right? I think that's part of the problem.
Having money isn't, though.
I think that's. I think, you know, speaking to friends in other countries around the world, I think we perhaps could be a little bit more ambitious, right? You know, do you want to be, you know, just like the States? Not sure. I think there's a healthy middle ground.
And what does that mean in practical terms? So for the founders who are in the audience, how are they showing that ambition? How are they demonstrating it? Like, what does that mean? Like, be more ambitious. Great. Like.
I mean, our most ambitious founders tend to go to the US. Because if you're thinking about building a very large company, you probably want to win the American market. And you would love to win the European market in addition to the UK market, but the European market is not, it's fragmented. It's not one common block. So you're almost better off going to the US first and then coming back to the rest of Europe. And so most of our founders end up going out to the West Coast, sometimes the East Coast. And then their peer group is people on the West Coast, on the East Coast, and the ambition naturally gets very raised because there is quite a bit of ambition, particularly on the West Coast, to build a very large kind of distinctive company.
Toby, do you see the difference between?
Yeah, and I mean, if we look at the companies that we've backed over the last 2 years or even much longer, definitely agree with what all of you guys have said. It's not been the Etonians quite yet. Even though I've got to admit I did go to a public school for the last 2 years in this country, but maybe that's why I'm not a founder or an ambitious founder. So I mean, we've backed founder, but the last two British companies that we backed were founded by Germans. That was before my time, one of them at least. So, but they're building in the UK. They chose to come to the UK for access, for funding, for talent, also for ambition. It's ambitious for a German founder to go to London, out of their comfort zone. So I think all of these, there's a lot of truth in what you guys shared, and it's certainly something that we've observed. We've not backed sort of. And the other thing I'd say is we see a lot of continental European companies wanting to go expand to the UK before the US because that's one step closer. I think that might be another area for the UK to capture smart, ambitious continental European founders that are looking maybe to go to the London before the US.
Neil, it'd be rude to have you on this panel and not ask you about the capital markets. So UK was once the largest stock exchange. Do you need me to tell you these stats? Or is
We were also once the largest empire. We're not going there, right?
And lots of unicorn founders publicly state that they won't be listing here or don't want to list here.
A few.
Okay, we'll compromise. How are you thinking about this? And you know, the very direct question of what are you doing about it? You
Great.
Personally?
I think thanks for raising that. It's an important point, right? First and foremost, I think there's a real perception issue here. You know, I'm fortunate to speak to all parts of the ecosystem. You know, see it live. You know, banks, investors, public, private markets, and I can tell you for a fact, Hannah, that it's not as bleak as sometimes the Twitter narrative is. We don't need to become the 53rd state of the US. There is stuff happening here. We've had 16 IPOs year to date. IPOs have been slow globally, right? If you do 3 things today, I'd recommend that you go and check out a podcast by Imran Khan with Harry Stebbings, just talking about the IPO market. Imran took Alibaba and Snap public back in the day. And fundamental reason why we're not seeing more IPOs generally is there's just a disconnect between public market valuations, we mark to market in real time, versus where we are in venture. But can we start unlocking that? Absolutely. when we see good companies like Raspberry Pi, they get support, including 70% of that book was from UK. So I fundamentally believe that IPOs can be a fantastic North Star. The second thing I was going to say is check out a podcast by Reid Hoffman, M&A versus IPO. And I think just building towards an IPO just make sure that you're better prepared. And the third thing in terms of what we're doing, third podcast, I just planned this on the cab here, is my CEO, Julia Hoggett, did a talk with Charlie Hall at Peel Hunt the other day, just talking about all the stuff we're doing at the stock exchange to improve this ecosystem. Is it perfect? No. Is it broken? No. Stuff works, but could it work better? Absolutely. And just to summarize, 5 things we're doing through the Capital Markets Industry Task Force is...
Shall I stop you now?
You can stop me.
No, you can carry on.
I'll make it quick. First thing is to level the playing field, right? So historically, people end up in Amsterdam for peculiar reasons. We've just undertaken the largest set of reforms in the listing rules in a generation, about 40 years, where you can have dual class shares, you can have lower free float, you can do M&A and raise capital a lot easier than it used to be. Second thing is improving access to equity research, right, and incentivizing that. Big issue in life sciences, less so in tech, where we've got 45 fintech analysts in London. Third thing is unlocking risk capital, so we touched on that. And fourth thing is corporate governance. We're in a remarkably better place than we were. Fifth thing we're doing is building the world's first regulated crossover market for secondary, which is to enable capital to get recycled faster. And the glove that fits these 5 fingers is the culture and how we talk about this. We're really good at talking ourselves down in the UK and not celebrating the actual things that we're good at. And I think that needs to change.
You've never been asked that question before, have you? I'm gonna come at it from a slightly different angle. Like, are we too bogged down in this issue and this problem? Like, does it not matter where companies list if they're employing people in the UK, or they're spinning out knowledge ecosystems here, or they're creating their mafia here? Is that really how we should be looking at this, or is that another way to reframe the problem?
I will say I was floored after the ARM IPO. There were all of these articles where people are writing, like, not like mean tweets, like articles about like ARM, abandoned the UK. And it's like, motherfucker, they are in Cambridge. Like, they're an hour away, less than that, on the fast train. Like, sorry, that face means I shouldn't have said the F word, but they're here and they're employing people here, and they're actually completely ruining Cambridge's traffic because they're so big. And what more do you want? They want to go make the most amount of money, and those founders and the employees and everybody else and their lawyers and their underwriters, they're going to be paying a ton of money back into this ecosystem, and it just feels like nothing's ever enough. It is not the ARM founders' fault that the London Stock Exchange is no longer the biggest stock exchange in the world, and they want to go build a really big company on a stock exchange that is very primed, when you look at NVIDIA and everything else, to accept the AI trade with open arms. Like, why wouldn't they do that? That's what's best for the people and the tax base, and that's the country. And instead, it's like, well, the queen would roll over in her grave. Let her, who cares? So I think that there's just this disconnect.
She's dead.
I said let her roll over in her grave.
Sorry. I was gonna
So I think there's a disconnect though between what looks good on an announceable, as I've learned the British government likes to say, and what's actually good for the actual people here and the actual ecosystem and economy and everything else here. I want people in Cambridge to make a ton of money so that they get bored, quit their jobs, move back to London, pass me on the street and say, wait, weren't you on that panel? We should talk. I have a new company, and then I can make money.
I feel like Hussein and Toby, we can't end there. We could end there, but we can't. I know it's almost 6 o'clock.
Does it really matter where?
Q&A in a minute.
Does it really matter where you end up listing? I think if you end up in places which overvalue you have to go through a correction of some kind. That's bad. If you list in places that are going to undervalue you, and I respectfully disagree with Neil. We took 2 of our companies public on the London Stock Exchange. I really hope to God we never have another one like that, because we're going to list them on the New York Stock Exchange or NASDAQ, because they trade at dramatic discounts on the London Stock Exchange. I think that's a structural problem. I think it's really hard to fix. You don't have equity research here. You don't have people who are willing to go long on growth stocks. They want dividend stocks. It's going to take a generation to be able to fix those things. And adding a few more letters in your Bloomberg terminal to put the extra letters of New York Stock Exchange or NASDAQ is super easy for an asset manager. You should go where the markets are going to fairly value you. And the markets will fairly value you in America.
Okay.
Can I counter?
No, I'm.
Come on,
I'm
Anna.
gonna,
There's no market for sub 5 billion in the US.
Well, you know what? I'll give you. We're going to end on a positive note. So we're gonna kind of do the equivalent of another whoop. And I'm going to come to you first. What are you most optimistic, hopeful, excited about in the UK?
Yeah.
What for 2025?
We're going to see IPOs from the UK and internationally for companies that are too small to succeed in the States. There are research analysts available. There's capital available for these companies. 60% of the capital in London is international. If there was an arb trade that would have been played out, there's very good reasons why some companies have been undervalued historically. But I think that's going to help return capital to VC here, and provide liquidity, and help with DPI and et cetera. So that's what's getting me out of bed right now, is providing liquidity.
I think that Donald Trump's going to be mostly terrible for the world, but I think he'll be good for capital markets globally, certainly good for the price of crypto, and good for all of the Americans who are like, you know what, we're finally doing it, we're getting out of here, and we definitely don't speak any other languages because our education system sucks, and we are, by and large, going to try to end up in the UK. And I think that is honestly good. I think that the US falling out of global favor in terms of a place to be is good for the UK most directly, because Australia is really far away and Canada's cold.
So we win by default.
Yes.
We'll take it.
I mean, 10, 15 years ago when we had these panels, we questioned whether there was anything happening in the UK. I think the question is gone now, right? And my guess is, and if I extend that to 2025 to say 2035, it's very clear we're going to build something of substance here. We're on the right trajectory. We're on the right journey. Yes, there's some problems on the edges. Yes, there's some differences of opinion on how to actually be able to do that. But by and large, there's an economy here that's working. And even with government interference, I don't think it's gonna be able to muck it up.
We are super excited about the UK, for once. We've, in the last 12 years, never seen as many exciting early stage companies in the broader financial services space in the UK, and we look at Europe from London, and almost half of the companies that we actually work on end up being in London or in the UK. So we're super pumped to make a few really interesting investments in 25, and a very high chance of them being based in the UK.
Yes, that's what we like to hear. Okay, we have 10 minutes for some Q&A. Please don't be tempted to say a comment. I know it's very tempting, but keep it to a question if possible. Am I going to bring this over? I can. Okay. Do you want to? I mean, I can speak loud. Yeah. If you just stand up, say your name, where you're from, not regionally wise.
Yeah. Hi everyone. Thank you for the talk, all of you. Always great to see spirited discussion rather than just everyone agreeing.
Got a mic here.
Thank you very much. My name is Dhruv Gupta. I'm CEO and co-founder of Nussmark, which is just finishing up its pre-seed round. There's my plug out the way. But before that, I was also a politician, which is what if you look me up online, you'll see I was the parliamentary candidate in West London for the Liberal Democrats. What I want to hear from each of you, maybe very, very, very quickly, is whenever we come to these sorts of talks, we hear either one of two things. Either we hear a lot of complaining about the UK or a lot of making excuses for the UK. And what I've loved to see recently is a lot of founders or VCs kind of making their kind of name heard in Parliament, actually trying to make change, whether that's James Wise at Balderton, Barney Hussey-Yeo from Clio, some of you might have seen recently, and whether you agree with him or not, Matt Clifford, and I have to respect him whether I agree with him or not, about putting his name out there and actually trying to make an opinion. So I'd love to hear what each of you individually is doing. For those of you who are making excuses for the UK, so I guess that would be Neil and Toby, what exactly you've done to kind of back that hypothesis in terms of changing that policy, and then from the people complaining about the UK, Sarah and Hussein, what you would do if you were in that position, rather than just
in what position?
In the position to make some policy change in this country.
Mine's really easy. I write checks to companies that go on to be great.
We try to do the same.
Yeah, I don't feel like I don't think that policy, at least at the earliest stages, I have policy problems on the venture side, but that's very niche for this audience, like as a fund, but that's like tax treaty shit. It's just like, I think that it's a founder mindset of understanding that like, I love a social safety net. America needs a much better one, but I don't think that a social safety net is necessarily the right place to start a company from, meaning like, don't go to the government first, go register with Company House, and then forget that the government exists, go build your company, pay your taxes, and don't kind of constantly be in this cycle of like, well, where's that grant? Where is this money? Because the government is not doing well right now. It doesn't have the money. This is not the priority. You're probably not going to get it. So I personally, if I hear an early stage founder, no offense, is spending time in Parliament, I'm like, I hope it's the cigarettes because that is not the right place to be spending your time. Don't smoke either.
I'm really grateful that some of these founders taken time to go meet politicians and learned firsthand, that there are some sensible people in government. You may not agree with everyone, but in terms of what we're doing at the stock exchange, right, collectively, is we could sit on the sidelines and not get involved, but we don't set the listing rules. We don't tell people what they can invest in. But we formed the Capital Markets Industry Task Force for this very reason to really show politicians what's needed in this country, right? Back to capital, fixing how we look at governance structures, helping them build Pisces, which will be hopefully a world first for the UK. So those are some of the things. And if you want to find out more, just ping me an email afterwards and I can direct you.
Anyone else?
Hello, Aaron was up earlier, but my question is, we've talked a lot, or you guys have talked a lot about whether the UK is attractive or not attractive in a completely broad, all VC areas are the same. Do you see areas, I don't know, call it, fintech, for example, versus clean tech or something like that, where it is better or worse in the UK? So, break it down a bit rather than general, all VC, but spaces.
I'm betting on a founder, and often, honestly, a lot of the most kind of ambitious, I think, early stage non-US companies still are domiciling in the US as sort of that kind of just tends to be what a lot of the companies do. So I'm often just writing you a check and I don't really care where you are. And so I think that fintech is an area that the UK should be really good at, and there's some sort of leadership there. But I don't think that it's industry swath specific beyond sort of the life sciences and deep tech where you should have a PhD in many of those things to be building a company in them. I think it really comes down to just how compelling the individual founder opportunity set is.
I'd say contrast. I think what the regulators did in fintech really enabled the fintech economy here to grow. I think the fact that Revolut sits here is a testament to the fact that the FCA changed the way it did kind of the sandbox regulation, the fact that Monzo sits here, et cetera. So I think we have a superpower in fintech. You'd know more about if that's continuing to this day, but definitely wave one, wave two of that was definitely enabled, I think. And weirdly enough, enterprise software, which is like the most cookie cutter business, we're extraordinarily weak at. And the talent pool here on go-to-market is not as good as it is in the US. Plus the US is where the majority of the customer base is anyway. So for enterprise software companies, they probably need to look to go to America. For fintech businesses, they probably need to stay here.
Even within financial services, I see some subsectors that are where the UK is thriving. Driven by the banks being here, insurance companies being here, asset and wealth management markets being extremely deep. And that naturally attracts more founders and spins out more founders that are going out and building great companies. There are other sectors that will benefit from maybe Donald Trump being elected. Climate. I think climate will be great companies in the climate space coming out of the UK, partly driven by regulatory environments that are conducive to building great companies by having ambitious goals as an economy. So I think there are quite a few differences, some more subtle than others, where the UK really stands out compared to other countries.
Does anyone have any other question? Oh, yeah, there's one at the back-ish.
Thanks. My name's Ravi. It's interesting. I'm going to try to keep this to a question without too much commentary. Am I just too naive in thinking that the simplest solution to this is, as Hussein said, just write more checks to smart people? Because while we're raising our new round now, exclusively with US funds because of the lack of ambitious capital here, is the true problem in the industry in the UK inefficient allocation of capital by bad allocators? Most of our pre-seed round was European funds, interestingly, but all of our worst interactions with funds were European. Like, why scapegoat the government when, in fact, we in this room have probably the widest influence to change?
I mean, I think if you look at, sorry, just to take this, if you look at the stats, the UK is not falling behind in terms of deals done, and in terms of first checks done, the UK is ahead of the US. And there's some interesting data. I feel like Adam French, partner at Antler, is the data person. I'm kind of wearing his hat slightly. The British Business Bank brought out some data comparing deals across stages between the UK and the US, and the same proportion of companies get funded at each stage. The sizes of those rounds are slightly different, but I don't think it's an issue that we're not deploying capital into founders. I think I don't know if I'm taking the wrong point from your comment or question. But I don't think it's about the lack of deals done.
I think what he's saying is give it time, like maybe a decade or two, and the bad people in this industry will get washed out and the good people will replace them. I think that's to paraphrase, that's kind of what I heard.
How are you defining a bad person?
Well,
I looked at you, I meant to look at him.
20 years ago in this industry, the venture industry was much more risk averse, much more conservative, much less likely to write a check into early stage. So contrast where we are in 2024 with even where we were in 2015 compared to 2005, there's been a seismic difference.
You know what, I guess I would get it, sorry to turn this into a debate, I would get it if it was compared to the US, but if you're comparing the UK
within
to Germany.
the UK, but a lot of those folks
why
within
would
the UK.
you compare it to Germany, though?
No, but he compared it to Europe, right?
I think that's just like a sideshow. I mean, I think the question is, a lot of those folks who are writing checks, like so the seed fund of record in 2005, there were two of them, Pond Ventures and Eden Ventures, and I bet you no one in this room knows either of those two names. They basically both went out of business after 3 funds, and they've been replaced by a whole new generation of seed funds that have come across. And my guess is if we're not competitive enough in the market, and we kind of ruin our reputations with founders, a new generation of folks will come in and replace us. And I feel like the capital markets now are deep enough where people do get funded to produce next generation funds. 10, 15 years ago is really hard, but these days you can build a next generation fund, and if you behave like a dinosaur, you'll go the way of the dinosaurs.
One thing I'll say is I've spent a ton of time in US ecosystems, tiny, tiny, tiny ecosystems all over the country, very nascent stages, early New York, Dallas, Iowa, whatever. In general, initially, it is big fish, small pond syndrome. And then people start showing up there. People from the coast discover that Chicago exists. And over time, all of this sort of like big bad, I'm gonna give you $100,000 at a $500,000 valuation, even though you have whatever 100,000 in revenue, VCs sort of go off and I don't know, they're probably like terrorizing McDonald's employees or something. But like they have to go do something else because they don't get to interact with the ecosystem the same way. And it's really sad for me. Like I'm not a Brit hater. I like live here, whatever. It's shocking to me how often when I talk to founders and they have kind of horror stories about, 20 meetings in, they're getting term sheets pulled, they're getting like the bad actors, like there's all of this stuff that really Silicon Valley has so many problems. Buy me a drink and I will tell you all of them. But like we generally have sort of gotten out of that. But it took a while, and it still has taken even longer for that to happen in New York or Dallas or other ecosystems. So I think that piece is sort of give it time because we can't force our peers out of business. We can't throw ourselves in front of every pitch meeting that you're taking with some asshole. But over time, you tell other people, and then nobody wants to take that meeting, and that person might still say that they're a VC, but they're probably day-to-day doing something else.
I'll just add that if Ravi's onto something, a good business, he's going to get funded, right? And it's going to be a tragedy if not enough UK VCs discover him and back him. Currently, it's really stark in public company land. We've gone from 53% allocation of UK pensions down to 4.4, and I know those statistics are even worse in venture. So really, who's losing out? It's pensioners, right? It's savers, it's investors in this country, and that's what we want to fix by getting more pensions capital into, hopefully, your hands as well.
Yeah.
Hi. Thank you, first of all. My name is Katrina. I connect founders and investors. And the sentiment and the types of conversations that I had the most with VCs is that the sector that they're the most interested in is B2B SaaS. This is almost every time I'm asking someone about their investment thesis, this will be the #1 sector of preference. And the least preferred sector would be anything related to consumer technologies. Is that the sentiment that you personally share? And do you have any opinions about why is that? Why do VCs are taking rather risk-averse approach in not being interested in consumer technologies? Thank you.
I mean, consumer has a lower hit rate, and I think when you have a more risk-averse ecosystem with less money in it, it's really hard to think that you're going to that you're going to find consumer that either works and scales massively. So CPG doesn't scale that well, and certainly doesn't scale in public company multiples. And then social networks, or the next TikTok, whatever. Like, good luck. There is no category where more money is just set on fire with nothing to show for it than failed social networks.
And the challenge with consumer is it's a low hit rate. It's much more capital intensive. It's less formulaic, so it's more like a hit movie than it is like an enterprise software business, which is, you kind of know what the milestones are. And then the waves that you kind of need to sit on top of in the industry, the last great generation of consumer companies were built on top of social, mobile, local. We haven't had one of these waves in a while. But then I say that, one of my fastest growing companies is an AI fashion company. And I just did a sustainability/consumer deal that takes chicken feathers and turns them into merino wool. So I would describe myself as a B2B enterprise software investor.
Thank you so much to you guys for joining on a Monday, almost evening. And thank you all for listening and for your questions. So with that, I'm handing over to Jed.
Hands up for our moderators.
One more time, a hand for this panel, guys. Yeah. You've seen this. Yeah, we got the QR codes. Just some closing remarks. First off, thanks so much to Google for hosting us, and to our speakers and panelists and our portfolio companies. A hand for everyone who participated. Thank you. I talked about in the beginning how we're an industry agnostic investor, and there's a lot going on across the ecosystem. I hope you got a taste of that this afternoon from hearing from our panel, the portfolio companies, and of course, Andrea earlier. I think also what we've heard throughout the sessions is there's a lot of optimism in the room. At Antler, we invest for kind of a 10-year time horizon, like a lot of the investors here. When you think back 10 years ago where things were compared to where they are today, I think there's probably a consensus that we're in a much stronger place. And I think also there's consensus that 10 years from now, everyone here is really excited about kind of the upside potential from there. And then lastly, we hope you have in the long term. And so we've got drinks and snacks outside. The QR code, I'll put that up, I think it's next slide. There we go. If you want to get in touch with any of the companies that you saw today, please go ahead and do that. And thanks again for coming out. Thank you, guys. Oh, one last thing. Can I give a shout out to Sarah Finnegan, who planned and organized everything here today? And the rest of the Antler team as well. One more hand for them, too. Go. Thanks, guys. See you outside.